Guys, can you please confirm if my audio, video and the screen is properly visible and clear to all of you? Can you please confirm, all of you? Fair enough. So let's start the session now. Okay. So first of all, a very good evening all of you. A very good evening to all of you. And I hope all of you have been preparing well for your ACCA financial reporting exams. Guys, this session we will not be discussing anything in detail, but yes, we'll try to cover as much as possible. We'll cover all the important concepts. We'll cover the past paper questions for group accounting, ratio analysis, and for single entity financial statements. We'll try to cover that also. We'll try to cover all few important questions which are complex and which have some important concepts hidden in them. We'll try to take up few questions as well in the class. Okay, but yes, what I will request is, before the class, try to revise the chapters which are being covered in the class. You already have the schedule with you, right? If you have, if there is any changes proposed, I'll definitely get back to you on that. But yes, the schedule which I have shared with you is the final one, and you have to follow that. So prior to class, always revise it and come, so that when you are revising these topics here in the class, you are understanding it, and when if you have any queries, you can ask those queries, right? So that's the intent of the revision series. Now, having said that, let's start our revision series. Now, so first topic that we have to discuss is tangible non-current assets. Now guys, let's understand that in a tangible non-current assets, the major assets which forms part is property, plant, equipment, and investment property. Property, plant, equipment, and investment property. Now let's understand this one, guys. What is the difference between property, plant, equipment, and investment property? See, property, plant, and equipment are the assets or are tangible assets which are held for use in the production or supply of goods or services. It might be used for administrative purposes. It might be used for giving on rental to others. Okay. Now, in comparison to that, what are investment properties? Investment properties are properties which are held for rental to others or for capital appreciation. Now you must be wondering that rental to others is coming in both, right? Then how to classify that? Guys, we have to understand that investment property talks from an investment perspective, right? From an investment perspective. Now think, will you invest in at any given point of time, will you invest in the plant and equipment for capital appreciation? No, you will not, right? So you will always invest in properties for capital appreciation, right? Because properties value appreciates, plant and equipment value depreciates, right? So always remember, plant and equipment will always be property, plant, equipment. Plant and equipment will always be property, plant, and equipment. Now coming to property. Property, if you have acquired for self-use or if you have constructed for self-use, okay, self-use means either for corporate office purposes or for admin purposes, right? Then it is called property, plant, equipment. If the property is held for rental to others or for capital appreciation, then it is called as investment property. Is that clear, guys? Okay. Now coming to moving on to next topic, that is recognition. In recognition, guys, you have to understand that in point number 1 we studied classification, that is whether this asset qualifies to be a property, plant, equipment, or this asset qualifies to be an investment property. Now if it classifies to be a property, plant, equipment, or an investment property, will the same be recognized in the books or not? solely getting classified as invested property or property plant equipment does not make it make us to recognize in the financial statements. For recognizing in the financial statements, these two conditions has to be satisfied. These two conditions has to be satisfied, which are future economic benefits are probable from them, and the cost has to be measured reliably. Cost has to be measured reliably. If either of the conditions are not being met, even if the assets qualifies to be a property plant equipment or investment property, the asset will not be recognized in the books of account. Is that clear? So both the conditions has to be met for property plant and equipment also, and for investment property as well. I hope it is clear to all of you now. Now guys, as I have been telling in the classes as well, that for any standard you have to study 4 things. What are the 4 things? First is meaning, second is recognition principle, third is measurement principle, and fourth is disclosures, right? So in this, first we studied the classification, that is the meaning. Second, we studied the recognition, right? Third, we have to study the measurement, meaning thereby first we understood, okay, what we are talking about. Second, we studied, okay, do we need to recognize this asset in the books or not? If the answer to that is yes, then the question comes up, at what value? And that's what is your measurement principle. Now coming back to measurement principle, see, now measurement principle will also be divided into 2 parts. One, initially how will you recognize or how will you measure that? Once you have measured it initially and recognized in the financial statements, how will you carry it forward? How will you carry it forward? Which is called a subsequent measurement. Which is called a subsequent measurement. Is that clear? Now initially property, plant and equipment and investment property, both of them has to be measured at cost. Initially it has to be measured at cost. What is a cost? Cost can include purchase price, cost can include non-refundable taxes, or cost can include any directly attributable costs, which is incurred to bring the asset in 2 things. Tell me, what are the 2 words? What are the 2 words which I used to discuss in the class? Tell me, what are the 2 words? Incurred any directly attributable expenses incurred to bring the asset in the dash and dash intended by the management. Tell me guys. It was location and condition. Let's suppose I have purchased a refrigerator, right? So and I have to bring from the seller's premises to my premises, so the transportation costs will be capitalized. Now let's suppose the refrigerator which I purchased is in dismantled form. I have to get it installed in my premises, right? So when I have to get it installed in my premises, I have to pay the installation costs, right? So that installation cost is also required to be capitalized. So this is condition. So any cost incurred to bring the asset in the location and condition intended by management is to be capitalized. It includes what? Tell me, what does it include? What does it include? What does it include? It includes any directly attributable costs. Any directly attributable costs. But it excludes specifically 2 things. Tell me what? Staff training costs, and I gave the reason also specifically, that we cannot control. See, let's suppose when we train our staffs or we train our employees, what happens basically is we don't control our employees. Let's suppose I have given training to my employees today and he resigns tomorrow. Can I stop him? No, I cannot stop him, right? So though I am incurring these expenditures, cost can be measured reliably, but future economic benefits are not probable, right? I am not able to control these costs. If I am not able to control, right, it will not be capitalized. Another example that I gave in the class was advertisement costs. Right? Another example which I gave in the class was operating losses. Right? Is it clear, guys? Now, one thing which you have to understand and keep in mind, which students generally tend to ignore and they forget this one. There is an addenda, there is an amendment, there is an amendment. Note. Tell me, testing costs will be capitalized or not? I told in the class that testing costs can be in two natures, in the nature of inspection or in the nature of market survey. Testing cost in the nature of market survey will not be capitalized. Testing cost in the nature of inspection will be capitalized. Do you remember this one, guys? Do you remember this one? Now, one more thing in this one, the amendment part. Let me take it with a red pen. See, when you incur costs on inspection, okay, or testing costs, okay, you might produce something, right? So, produce of testing. Right? So, this can be sold in the market. And what I told in the class was, when this is sold in the market and the amount is received, you can deduct this amount from the cost. I told in the class to deduct it from cost. Right? But now this is an amendment that you do not need to deduct it from the cost. No, you should not. The amendment is you should not do this. Rather, this should be transferred to P and L. This is an amendment. So a question might come on this topic. Be very careful, guys. Be very careful, guys, in the exam. Okay. A question might come on this topic. Produce of testing when it is sold. It will be transferred to P and L. Okay. Is that clear, guys? Is that clear to all? Now, subsequently, how will we measure it? Subsequently, we can measure it at a cost model or revaluation model. Now, subsequently, whether we are opting for cost model or we are opting for revaluation model, we have to understand that the choice will be for a specific class of assets. Right? It's not that let's suppose if I am having plant and equipment, let's suppose plant and machineries, let's suppose 10 plant and machineries in the same class of assets. 10 plant and machineries in the same class of assets. I cannot do so that for 8 machineries I will apply cost model, and for the last 2 machineries I will apply revaluation model. No, for all the 10 machineries I have to apply either cost model or revaluation model. Right? Now, similarly, if I am having a building, right, the building can also be of two types: industrial building and official building. Right? So official building might be carry forwarded at revaluation model. Industrial building might be carry forwarded at cost model. Right? But it will never be the case that if we are having two industrial building, one industrial building is valued at cost model and one at revaluation building. No, the classification or the subsequent measurement will apply to overall class of assets, and not to a specific asset in one class. Okay. Now, also we need to understand that investment properties are one class of assets. Okay. So if you are opting for cost model or if you are opting for revaluation model, that will be applied to all the investment properties. Okay. So for investment property, either we can follow cost model or we can follow revaluation model. In investment property, there are no subclasses. Investment property itself is one of the class. Is that clear, guys? Now, what is the difference between a revaluation model of property, plant and equipment and a revaluation model of investment property? So as I was telling right now, that it will be applied for revaluation model of property, plant property, plant and equipment, it will be applied, this model will be applied to a class or group of assets. But for revaluation model of investment property, to all investment properties, right? Frequency is once in 2 to 5 years. Now, tell me what is the frequency here? The revaluation model of investment property. What is the frequency here? It is every year. It is every year. Every year we have to fair value. In revaluation model of investment property, we have to revalue every year, right? Now, how will we charge depreciation for a revaluation model of PPE? If we are following revaluation model under PPE, how will we charge depreciation? Carrying amount revised divided by remaining life. Remaining life. And how will we charge depreciation here? Here no depreciation. Why? Because the fair value changes. The fair value changes of investment property on revaluation goes to P&L, and that is the charge to P&L. That is the charge to P&L, and no specific you can say depreciation is charged. No depreciation. Okay. So you can write here gains or losses is transferred to P&L. Is transferred to P&L. Is that clear, guys? Is that clear to all? Now, treatment of a revaluation gain or loss. Okay, now let's understand this one. Okay, see, as you know that a revaluation gain, okay, I will just follow the method which I have used in the class. First time you get a revaluation gain. Tell me, where will you transfer that? First time you get a revaluation gain, where will you transfer that, guys? Come on. First time you will get a revaluation gain, where will you transfer it? OCI, revaluation reserve. Very good. Revaluation reserve or revaluation surplus. Now subsequently you get revaluation again. Tell me, where will you transfer that? Again, revaluation reserve. But subsequently if you get a revaluation loss, tell me, where will you transfer that? Subsequently you get revaluation loss, where will you transfer that? First time and subsequently. You will adjust with revaluation reserve. Adjust with revaluation reserve. But any excess will be transferred where? Tell me, any excess? Any excess will be transferred to P&L. Now, first time, again, let me take another one. First time you get a revaluation loss, then it will be transferred where? Tell me, where will be transferred to? First time you are getting a revaluation loss, where will it be transferred to? P&L. Very good. Will it be transferred to P&L, and subsequently you get a revaluation loss, or subsequently you get revaluation gain. Tell me, where will this be transferred to? If you are getting subsequently revaluation loss, it will be transferred to P&L, right? Subsequently, you are getting a revaluation gain. Where will this be transferred to? Tell me. Subsequently, you are getting a revaluation gain. It will be transferred to P&L, but any excess will be transferred to any excess will be transferred to revaluation reserve. Is that clear, guys? Is that clear to all? Okay, now just let me highlight this one. Now coming to treatment of revaluation surplus. Okay, now how will you treat that? So as I have told in the class, there are two methods of treating, method 1 and method 2. Two methods of treating it, right? Two ways of treating it. Can you tell me what are the two ways of treating it? Transfer of revaluation reserve to retained earnings at the time of, tell me when, at the time of, tell me when, disposal of asset. What is method number 2? Transfer of retained revaluation reserve to retained earnings every year over remaining useful life. Of asset. Is that clear, guys? Is that clear to all? Is that clear to all? Method 1 and method 2? Over the remaining life, over the period, every year. Very good everyone, very good. Now coming on to transfers, the transfer cases. Okay, now transfer from PPE to investment property or investment property to PPE. Guys, we must understand that solely saying that the intent of management has changed, that the management wants to earlier it was investment property, now the management wants to classify it as a property, plant and equipment, just because of change of intention. Can they transfer? No, there should be a evidence for that. What should be the evidence? First, earlier the property was given on rental, right? Now the property is not given on rental. Now the property is held for self-use, and the owner or the entity has started using the property for self-use. So then you can say yes, there is an evidence, and we can transfer the property, plant, equipment to investment property, or investment property to property, plant, equipment, as the case may be. Right? But when we are transferring, whenever we are transferring, I have told in the class also few the guidelines. Let's suppose this is the date of transfer. Okay, this is the date of transfer. Now let's suppose you are transferring from PPE at fair value model to IP . to IP at cost model. Then how will you transfer that? So it says that whatever is the fair value on this date, okay. Now see here. So you will first the entity will do the fair valuation till here, and it will treat it as per the old policy. Whatever changes are happening till the date of transfer will be dealt as per the old policy. From the date of transfer, the new policy will be used, or I can say after the date of transfer, the new policy will be used. I can say from here the new policy will be used. New policy. Till date of transfer, old policy will be used. Okay. Now in this case, how will we transfer? How will we do that? Fair value till the date of transfer. I'll write here. Fair value till date of transfer will be transferred to revaluation reserve, right? The fair value on the date of transfer will be equals to cost of investment property, and now this will be depreciated over remaining life. Now let's suppose PPE is at cost and IP is also at cost. Then what will we do? In that case, here what will we do is we'll follow the cost, everything, right? So the cost is being followed, right, before the date of transfer, also after the date of transfer. What changes is just the nomenclature. But let's suppose PPE is at cost but IP is at fair value. How will we deal this case? So it says, the standard says for this one, that again the whatever is the fair value here, okay, so this will be transferred to revaluation reserve. And from here the the fair value gain or loss will be transferred to P&L. So there is no depreciation in IP. Why no depreciation? In cost model there will be depreciation, right, Vidisa? In cost model there will be depreciation, right? In fair value model there is no depreciation. In fair value model of investment property there is no depreciation, but in cost model of investment property there is a depreciation. Yes, we have to find the fair value on the date of transfer. Yes, we have to find in this case fair value, in this case we don't need to find fair value, because prior also cost, after also cost. Then why is fair value required? Is it clear, Manav? Okay. Is it clear, Manav? Okay. Now coming to borrowing costs. Okay. In borrowing cost, if you remember in the class we discussed three things. One, when can the borrowing costs commence, capitalization commence? When can it cease? And when can it suspend? But before that, let's understand that borrowing costs, any borrowing cost incurred on the qualifying assets has to be capitalized. Okay, borrowing cost incurred on the qualifying assets has to be capitalized to the cost of the asset. Is that clear, guys? Is that clear? Borrowing cost incurred on the qualifying assets has to be capitalized to the cost of the asset. What are qualifying assets? Any assets which take substantial period of time to get developed, right? We now have a query, sir. In the first case, will RR be transferred to RE over the period? Which case you are talking about? Are you talking about the transfer case? Transfer first case, this one? Okay, if you're talking about this one, this case, you are telling will RR be transferred to our RE over the period? See, that is a choice which the company has to opt for. Okay, will I transfer RR to RE over the period, or will I transfer RR to RE at the end of the disposal of the asset? That is a choice that the discretion of the entity. Okay, so it's not that we have to make a choice here. Okay, the question will specify that clearly. Don't worry about that. Now, okay, so we have to understand that when can the borrowing cost capitalization commence, when can it cease, and when will it suspend. Okay, this is the three things which we have to understand. Commence. So for commencement, again, three conditions has to be satisfied. What is the three conditions? First, construction activities has started. Right? Second, expenditure has started being incurred. Third, borrowing costs are being incurred. When all these three starts happening, all the three starts happening, from that date you have to start capitalizing the borrowing cost. Why we are talking about all three? Let's discuss that. Let's suppose I have incurred the expenditure. I have given an advance to builder. Okay, so expenditure it started incurring. I have taken a loan also, so I am incurring borrowing costs also, but the construction is not yet started. So can I capitalize the borrowing costs? Because the borrowing cost can be capitalized for the construction period. So borrowing cost cannot capitalize. Let me take another example. Let's suppose I have started incurring expenditure, construction is also started, but I have not taken any loans. As of now, I have not taken any loan. Will I capitalize borrowing costs? No, I will not. Right? Construction is started, I have taken loan also, but I have not started incurring any expenditure as of now. Will I capitalize any borrowing costs? No. Right? So all the three has to be satisfied. All the three conditions has to be satisfied for borrowing cost to be capitalized. Okay. Now, when will it cease? When the asset is completed, the fully or in part. When the asset is completed fully or in part, then the asset will be capitalized. Then the asset can be, then you can say we can cease the capitalization of borrowing cost. Is that clear, guys? Is that clear to all? Now, so we can write in cease when when the asset is completed either fully or in part. So for that part we can cease the borrowing costs. Okay, for the part which is not yet complete, we can continue capitalizing the borrowing costs. Suspend. When can we suspend? We can suspend when there is an abnormal halt to construction work. Example is labor strike. Is that clear, guys? So when the borrowing cost can commence, when the borrowing cost can cease, and when the borrowing cost can suspend the capitalization. Okay. Now, just one more thing in borrowing cost. Just one more thing in borrowing cost, and we'll be done with the non-current tangible assets. Okay. Now, see the borrowing cost. When we are talking about borrowing cost, we have talked about the borrowing also, right? We'll talk about the borrowing also. So borrowing can be of two types. Borrowing can be of two types. One is general borrowings and one is specific borrowings. What is general borrowing and what is specific borrowing? General borrowing is a borrowing basically we have taken for general corporate purpose. I might use it for giving salary, I might use it for general day-to-day expenses, I might use it for construction of a building also. A specific borrowing is taken for a specific purpose, right? The purpose might be construction of a building, right? So how will we treat it? For general borrowing, first we will calculate the average rate of interest. Why? Because there might be more than one general borrowings with the company, right? Second, we will calculate average expenditure, and third, we will calculate the borrowing costs to be capitalized. Now, specific borrowings, actual borrowing costs incurred, less investment income from surplus funds. Why surplus funds? I'll explain the reason for that. What happens basically, let's suppose I have taken a loan of 20 lakhs for construction of a building. Will I require 20 lakhs today itself? I might require 2 lakhs now. I might require 3 lakhs after 3 months. I might require 4 lakhs after 6 months, right? So it will be requiring parts, right? So similarly, the idle funds will not be kept in the bank account. Right? It will be invested somewhere. Right? So the total borrowing cost which I am paying to bank, in that I reduce. If I invest the funds, I'll get some investment income, right? I'll reduce that. The net amount is the borrowing cost that has to be capitalized. Tell me, is that clear, guys? Is that clear to all about the borrowing costs? Now, want to solve some questions now? Let's solve some question, guys. Practice quickly. These questions are taken from BPP workbook, guys. Okay. Now we'll solve it quickly. Let's solve question number 25. This is from your BPP practice kit. Carriageways had the following bank loan outstanding during the whole of 20x8. So 9% loan, the amount is 15 million. 11% loan, the amount is 24 million. Carriageways began construction of a qualifying asset on 1st April 20x8 and withdrew funds of rupees 6 million to that date on the to fund the acquisition. On 1st August 2008, an additional of rupees 2 million $2 million was withdrawn for the same purposes. Calculate the borrowing cost which can be capitalized in respect of the project for the year ended 31st December 2008. Let's solve it. Question number 26. So it says it has two loans here, GL1, GL2. What is the average rate of interest? Can anyone calculate and tell me what is the average rate of interest? I'll show the question. What is the average rate of interest? Tell me, please. Tell me, guys, what is the average rate of interest? 10.2, 10.23 it is coming, right? Average rate of interest is 10.23 percentage, and I believe all of you know how did I calculate it. 9 million multiplied by 15 percentage plus 24 million multiplied by 11 percentage, that is equals to 1.35, that is equals to 2.64. So 1.35 plus 2.64 is 3.99. So divided by what is the total loan? 15 plus 9 plus 24. 9 plus 24 is 33. So what is the amount? 33.99 divided by 33 is 3.99 divided by 33, or 3.99 by 15. Just a minute. It is 15 and 9%. Sorry, I have taken it wrongly. It's 15 and 9%, not 9 million 15%. I have taken it reverse. Okay, so this amount will change. 24 plus 15. 24 plus 15 is 39. So the amount is 39. 3.99 divided by 39 is 10.23 percentage. Right now, okay. So now further it says that it has taken a loan during what date? See, year ended is 31st December 2008. This is 31st December x8. Now on 1st April it began the construction of asset and withdrew 6 million on 1st of April. Okay, so 1st of April it withdrew how much? 6 million, and then it withdrew 1st of August 2 million. 1st of August it withdrew 2 million. So now in this amount, this is the amount period of capitalization. For this one, this is a period of capitalization. So what is the borrowing cost to be capitalized? 6 multiplied by 10.23 percentage multiplied by 9 by 12, and for this one it is 2 multiplied by 10.23 percentage multiplied by 8, 9, 10, 11, 12, 5 by 12. So what is the amount? 6 multiplied by 10.23 multiplied by 9 by 12 is 0.46035, and it is 2 into 0.023 is 0.08525. If we add it up, is 5456, 0.5456 million. Now if you see the question, 5456 million means around 5,45,600. So what is the nearby answer? 5,45,000. See, this is the nearby answer, right? 549,333. So this is the answer. Nearby answer, this is the answer. 549,333. 25. A is the answer. A is the answer. Is that clear, guys? Everyone? Is that clear, everyone? A is the answer. A is the answer, right? Now 26 is for specific borrowings. I think you can solve it on your own. 26 is specific borrowings. You can solve in your own, right? Question number 26 is specific borrowing. You can solve on your own. Now moving on to next. Let's solve question number 28. Identify whether each of the following is true or false in accordance with IAS 40 investment property. Following initial recognition, investment property can be held at either cost or fair value. Tell me, it is true or false? Tell me, guys, whether it is true or false. Following, that is, says subsequently investment property can be at cost or fair value. True, right? It is true. It is true. It is true. If an investment property is held at fair value, this must be applied to all of the investment properties, right? That's what I told, that investment property is in itself one class of asset. So whatever policy will apply to all the investment properties. So if the investment property is at fair value, this must be applied to all the investment properties, right? And investment property is initially measured at cost, including transaction costs, right? True. Initially, either property, plant, equipment or investment property, all of them are measured at cost. All of them are measured at cost. Avinav, why false? Why false, Avinav? It's true, right? It's true. Now, what is the last one? A gain or loss arising from a change in the fair value of investment property should be recognized in revaluation surplus. True, right? Tell me who all are for true. Last fourth point, 28, question number 28, fourth point, who all are for true? Question number 28, fourth point, who all are for true? Anyone for false? Manav false, Vidisa false, Rajat true. Rajat, how come true? What we discussed right now, like when we are discussing, so the investment properties, the gain or loss, revaluation gain or loss should be transferred to P&L. Property, plant and equipment, the revaluation gain or loss is transferred to revaluation reserve, not for investment property, not for investment property. Are you understanding where you guys are making mistake? Okay, coming on to question number 32. Coming on to question number 32. This is for a transfer case. This is for a transfers question. Question on transfer. It is a Carter company vacated the head office building and let it out to a third party on 30th June 20x8. Building had an original cost of 900,000 on 1st January 20x0. Okay, so let me solve this question. Question number 32. Question number 32. Cost on what is the cost on 1st January 20x0? 1st January 20x0 is 9 lakhs and life is 50 years. And life is 50 years. Okay. Now, what does the question say about current year? See, Carter vacated the head office building and let it out to a third party. Means vacated means self-use is getting over, rental is starting, means property, plant and equipment to investment property on 30th June 20x8. On 30th June 20x8. What is the year end? 31st December 20x8. 31st December x8 is the year end. Okay. Here it was property, plant and equipment. Here it becomes investment property, and this is at fair value. Now, so let's calculate what is the carrying amount on 1st January x8. Tell me what is the carrying amount on this date? How many years has passed by? From this date to this date, how many years has passed by? 1, 2, 3, 4, 5, 6, 7, 8. 8 years, right? So the carrying amount here will be 9 lakhs minus 9 lakhs divided by 50 years multiplied by 8 years, right? Which is equals to what value? You are calculating till here, Vidisa? I am calculating till here. I am calculating till here. So it's 8 year for me. Okay. So it's 756. Carrying amount is 756. Who all are calculating 747? I need to understand the justification. Might be they are taking 8.5 years and finding it here. Now please find what is the depreciation for this period. Please find what is the depreciation for this period. What is the depreciation for this period? Tell me. Again, it is 900,000 divided by 50 multiplied by 0.5 is equals to 900,000 divided by 50 into 0.5 is 9,000. So what is the carrying amount here? Carrying amount is minus 756, 747,000. Right? Now, what is the fair value here? Tell me. Let's see what is the fair value. Fair value is 950. So now, where will this transfer to? Where will this gain or revaluation gain be transferred to? Revaluation gain of how much? 950 minus 747 is 203,000. 203,000. Tell me, where will this be transferred to? That's my question. Where will this be transferred to? Revaluation reserve. Very good. Very good. It will be transferred to revaluation reserve. And what is the question? What amount will be shown in revaluation surplus as at 31st December 20x8 in respect of the building? The answer is 203,000. Now the question also gives you that at the year end, the fair value of the building is estimated to be 1.2 million. It says that the fair value here is 1.2 million. Now for that you should write that the differential, that is 2.5 million, sorry, not 2.5 million, 0.25 million, 0.25 million should be transferred to P and L. Should be transferred to P and L. I hope question number 32 is clear to all of you now, and transfer case is also clear to all of you now. Is it clear, everyone? Come on, guys. Okay, fair enough. Now, coming back to our discussion, we'll start with the topic 2, that is intangible assets. Well, let's start with the topic 2, intangible assets. Now, what are intangible assets? What are intangible assets? So basically, the guys, intangible assets are the assets which are identifiable, You can separately identify them either through contractual rights, or they are separately identifiable on their own. Okay, or they are separately identifiable on their own. Now, without any physical substance. Now, identifiable without physical substance, that is debtor also. A debtor is also identifiable and does not have any physical substance. So can I say a debtor is also an intangible asset? No. So for that, what I have to do? I have to remove the monetary assets. Why? Because those are covered by financial instruments chapter. That is IFRS 9, financial instruments covers, right, the monetary assets. So we are not covering the monetary assets in our purview, right? We are covering only the non-monetary assets. We are only covering the non-monetary assets, right? So what is an intangible asset? Any identifiable asset which are non-monetary in nature, and which does not have any physical substance, Any asset having these three criterions, or these three qualifications, or these three features are called as intangible assets. And to your surprise, all the recognition criteria, measurement criteria, everything is exactly the same as property, plant and equipment. Okay, now coming to recognition criteria. What was the recognition criteria of property, plant and equipment? Tell me. Future economic benefits are probable are probable plus cost can be measured reliably. Same thing is applicable here as well, right? So you are not required to study intangible assets and property, plant and equipment separately. Rather, both of them are same topic with certain exceptions and explanations that definitely that are there. But yes, majorly they are the same. Majorly they are the same. Coming to measurement. Coming on to measurement, again they are again the same. Initially, it will be recognized at cost. Initially, it will be recognized at cost. Cost includes what? Any directly attributable costs, right? Any directly attributable cost incurred to bring the asset in the condition intended by manager. Not location, not location, not location, only condition. Why? Because it's an intangible. It does not travel the location. Okay. Now, subsequently, how it will be measured? Subsequently, it will be measured at cost model or revaluation model. Again, revaluation model is exactly the same as PPE revaluation model, exactly the same, no difference. But yes, we need to understand here one thing, that we can use a revaluation model for intangible assets only if there exists something, only if there should exist something. What? Only if active market, only if active market exists. Why active market exists? Now let's suppose Zomato has its brand name. Zomato has its brand name. How will it get the fair value of Zomato? How will it get the fair value of Zomato? Is the brand name of Zomato get sold openly in the market? Sold openly in the market? No, it's not. It's not sold openly in the market. And if you think that I'll get the fair value by using an expert, that might be manipulated. That might be manipulated, right? So our standard says we can use the revaluation model if and only if active market exists. What is the meaning of active market? Sold in an open market with sufficient volume and frequency. Sufficient volume and frequency. Okay, it's not that it's being sold only once or twice. It should be sold frequently. It should be sold in volume also. Okay, not only 1 unit or 2 units are being sold. Should be sold in volumes. Like let's suppose accounting software license. They are sold openly, right? They are sold in volumes. They are sold frequently. An entity, can you apply a fair valuation model for that? Brand name. No, entity cannot apply a fair value model for that. No, it cannot be applied. So that's how we have to understand and analyze things. Okay. Now, coming to internally generated intangible assets recognition. See guys, internally generated intangibles and internally generated property, plant, equipment. What's the difference? What's the difference? Guys, internally generated property, plant, equipment can be capitalized, and internally generated intangibles also will be capitalized. But what happens? Let me take up internally generated intangibles example, goodwill or brand name. What happens? These internally gets developed. Right? And the entity doesn't pay anything for that. Okay, for let's suppose I am teaching from last 5 years. Let's suppose if I'm teaching from if I continue to teach for the next 10 years, a goodwill will be developed. A goodwill will be developed, right? A goodwill will be developed, right? Have I paid any price for that? No, I have not paid any price for that, right? Definitely I have put some efforts for that, but yes, not paid any price for that, right? I have not paid any price for that. So it will automatically get developed. The goodwill will automatically get developed. The question is, can I recognize that goodwill in my books? No. Why? Because again, go to the recognition principle. Future economic benefits are probable and the cost can be measured reliably. So for this goodwill of mine, definitely there are future economic benefits. But can I measure the cost? No, I cannot. Right? So for internally generated intangibles, recognition can be recognized. But yes, can be recognized at development phase. Definitely we'll discuss what is development phase. Okay, but yes, for assets like goodwill, for assets like brand name, since it will not be recognized. Why? Because cost is not available for these. The cost is not available for these. Now again, when we will study group accounting, in day 4, there I'll say the acquirer company, the company who has acquired the subsidiary, right? That company will be able to recognize this goodwill and the brand name. Why? Because that company has paid a price for that. Though the subsidiary will not recognize this one, but the subsidiary, the parent company will be able to recognize the goodwill, will be able to recognize the brand name. Why? Because it has paid a price for that. Okay. Now coming to research and development phase. Guys, what happens whenever an entity develops any intangible asset? Let's suppose the COVID vaccine formula. The formula was an intangible asset, right? So first research goes on, and then once the research is successful, then the development starts. During research phase, we gain knowledge. During development phase, we apply the knowledge that we have gained in research phase to develop the asset. So our standard says to differentiate between research phase and development phase, you can follow this 6 conditions, PIRATE, followed abbreviated by the term PIRATE. What is PIRATE? That is probable future economic benefits are probable, right? Intention is there to develop the asset, right? There are you can say it is technically feasible, economically feasible, and we have the ability to use the asset. We have the resources available to develop the asset, right? So basically it means the asset will have economic benefits. We want to develop the asset. We have the willingness to develop the asset. We have the resources available to develop the asset. And if the asset is developed, it will be feasible. Again, I'll repeat it off. Understand? Asset will have future economic benefits. We have the resources to develop the asset. We want to develop the asset. Okay. Now we have the ability also. And if the asset is developed, it will be feasible as well. Okay. So that's what is called. If all these conditions are satisfied, then the question says that you have entered the development phase. Before that, you are in research phase. So it says that whenever you are in research phase, all the expenses incurred has to be transferred to P&L. Why? Because future economic benefits are not probable. When I am researching on anything, I am not sure whether this will lead to, will I be succeeding in this or not. If I am researching on something, my intention is not to succeed, my intention is to gain knowledge. But once I have gained the knowledge and I have researched that, okay, yes, it can be successful, and when I am developing the asset, it is then the future economic benefits must be probable, right? So development phase will be capitalized. Is that clear, guys? Is that clear to all of you? Now coming on to measurement principle. Guys, we must understand that research phase, any expenses incurred, if we incur any expenses in research phase, it will be transferred to P&L. Might be in development phase the point where PIRATE gets satisfied. Before that, any expenses incurred will be transferred to P&L. Any expenses incurred after the PIRATE is satisfied, it will be capitalized. Now the question is, in this period of capitalization, can I amortize the asset? No. I cannot amortize asset. Once the asset is fully capitalized, once the asset is fully capitalized, fully capitalized, once the asset is fully capitalized, then from that date the amortization will begin. From that date the amortization will begin. Is that clear, guys? I hope this chart will be helpful for you guys. Tell me, is that clear to all till here? Is that clear to all till here? Okay, fair enough. Coming on to amortization. Now, amortization, as we know that we will amortize the intangible assets over the useful life. Okay, generally this is the investments is a monetary item. Yes, Rajat, investment is a monetary item. Okay, now, but there are certain intangible assets that are not amortized but are tested for impairment. Can you name them? Can anyone name them? First and foremost is development, or I'll write here expenditure incurred in development phase. Right? They are not amortized. See, just now I told, right? They are not amortized, but they are definitely tested for impairment. Right? Now, again, another is goodwill. Right? Another is goodwill. You can use customer list also, right? If it is not for finite life, or any intangible assets, with infinite life. It will cover your customer lists, it will cover everything. Infinite or indefinite life. Okay, a better term is indefinite, I think. Thank you, Naman. Indefinite life I will write. That is a better term to use. Indefinite life. Right, mastheads, that also can be used. So this is all about your intangible assets. Tell me, guys, any other queries that you have for intangible assets that we can discuss it now? Tell me, guys. If not, then we can solve questions. Market investment and investment are two different things. Rajat, let's discuss that in financial instrument chapter. Wait, it will be better. Investments can be current and non-current, but market investments are short-term and liquid investments. Okay, let's solve questions, guys. Let's solve certain questions. Purchased goodwill will be recognized, Rinki Khanna. Purchased goodwill will be recognized. Intangible assets. Question number 34. I hope you can see my screen. If you have acquired brand and customer lists in a business combination, then only it will be capitalized. Exactly, Naman. Exactly. Okay. let's solve question number 34. Asoria company had $20 million of capitalized development expenditure at cost brought forward at 1st October 2007 in respect of products currently in production, and a new project began on the same date. Okay, the research. Okay, let me first draw the chart for that. 1st October X7 and 30th September 2008. Okay, now it has capitalized development expenditure of $20 million. Okay, the research first phase of this project, okay, on this date itself the new project started, lasted till 31st December. Okay, and incurred 1.4 million costs. So in this period 1.4 million is incurred. Okay, from that date the project incurred development costs of $800 per month, $800 per month, $800,000 per month. Okay, till what date? On 1st April 2008, the directors of Asoria company became confident that the project will be successful and yield. Okay, from this is research phase. Let me write here. This is research phase. This is development phase. On 1st April 2008, on 1st April X8, it became confident, means pirate satisfied here. Pirate is satisfied here. Okay, the project was still in development on 30th September 2008. Capitalized development expenditure is amortized at 20% per annum. Okay, fine. So it is still under this one. Okay, so now this will be capitalized. This will be transferred to P&L, and this will be transferred to P&L. Right? What is the question? What is the amount charged to profit and loss for the year ended 30th September 2008 in respect of research and development costs? Very simple question. It is 1.4 million. In this 800 per month, 800,000 per month, multiplied by how many months? For 3 months, that is 2.4 million. Right? Now this will be depreciated as well, right? So at what rate? 20%, right? So amortization of 20 million multiplied by 20% is 4 million, right? So if we add 1.4 plus 2.4 is 3.8, 3.8 plus 4 is 7.8 million, is 7.8 million. Is it clear, guys? What is the answer? 7.8 million. See, this is the answer. 7.8 million is the answer. I hope it is clear, guys. I hope it is clear. Third one is the answer. Very good. Now let's solve 35. Identify whether the following internally generated items are eligible or ineligible to be recognized as intangible assets in accordance with IAS 38 intangible assets. Tell me, a customer list built up over the last 10 years of trading updated for the customer's current preferences. Did I incur any cost for that? No, right? Though it will have my future economic benefits to me. Right? But since I have not incurred any cost, it's an internally generated asset, right? Hence I cannot capitalize that. So it is ineligible. Specialized tooling of a new product developed by the business, right? So it has incurred cost also for that, right? So it is eligible. Working version of a new machine that uses a new technology used for testing the prototype apparatus, right? So it is eligible again. The title, heading, font and design of a front page of a major broadsheet newspaper. It is again ineligible, right? Because we have not incurred any cost for that. It's internally generated. Is it clear, guys? Question number 35 is clear to all? Question number 35 is clear to all? Okay, now 37 is similar question like what we have discussed to 34. Okay, so I think you will be able to solve question number 34 on 37 on your own. Please solve 37 on your own, guys. Okay, so that's all for intangible. Let's move on to the third topic, that is impairment of assets. Let's move on to a third topic called impairment of assets. Okay. Now, impairment of assets. See, guys, this impairment chapter comes up from the recognition principle of non-current assets. What does the recognition principle says? Whatever assets you are recognizing in your books, the assets should have economic benefits. Meaning thereby, if I am recognizing any asset in my books of $100, a bare minimum it should have a economic benefit of at least $100. Right, at least $100 should be the economic benefit from that asset, right? Now, similar from that concept itself, this concept of impairment is coming up. It says that if the asset is recognized at a value, and its recoverable amount and its economic benefit are lower than that, its economic benefits falls lower than the value at which it is recognized in the books of account, then you have to reduce the value also. Then you have to reduce that value also. Then you have to reduce the carrying amount as well. And this reduction in carrying amount is called as impairment of assets. So what is general principle? What is general principle? So general principle is, if the carrying amount exceeds the recoverable amount, what is the recoverable amount? Future economic benefits. I'll explain the recoverable amount as well, don't worry. If the carrying amount exceeds the recoverable amount, then we impair the asset. That's the general principle. But yes, we have to understand that when we are talking about the assets, this is only the non-current assets. We are not talking about the current assets. Right? Like inventories, because the current assets have a separate provision. Right? Like inventory has a provision of like cost versus NRV analysis. It has a provision for impairment. Financial assets, it has their own provision for impairment. So we are talking about only non-current assets. Okay, we are not talking about the financial assets. We are not talking about the short-term or current assets. We are not talking about those assets. Okay. Now that's the general principle. Now, what is the meaning of recoverable amount? Guys, economic benefits from the asset can come in two forms. Let's suppose if I have this pen, I can get the economic benefit either by using this pen, right? I will use the pen, I will generate inflows from my students, right? And it will that will be one of the value. Another value is if I sell this pen, right? So economic benefits can come in two forms. One is by using it, another is by selling it. Now, tell me, if I use this pen, I'll get a value of rupees 200. But if I sell this pen, I'll get a value of rupees 50. Tell me what a rational person will go for, using or selling? Tell me, what will a rational person go for, using or selling? If I use this pen, I will get rupees 200. If I sell this pen, I'll get rupees 50. What will a rational person try to do? Tell me. Use, right? Use. So basically, recoverable amount is higher of value that is derived from using, that is value in use, or the value that is derived from sale, that is fair value, less costs of disposal, cost to dispose the asset, fair value less cost to dispose the asset. That is the meaning of recoverable amount. That is the meaning of recoverable amount. Is that clear, guys? Is that clear to all? The general principle behind impairment of assets, the general principle behind impairment of assets is clear to all? Now comes the concept of cash generating unit. What is the meaning of cash generating unit? Guys, many times what happens, let's suppose, can I say individually with the help of this pen, individually with this pen, I can generate revenue? No. I'll require this laptop, I'll require this monitor for seeing your queries, I'll require this camera for so that you guys can see me, I'll require this mic so that you guys can listen me properly, right? I'll require this watch to see the time properly so that I can start the class on time, right? I'll require all these stuffs properly. I'll require this writing pad so that I can write in on this and you can see it, right? So all those things are required as a cumulatively for me to generate the revenue. For me to generate the revenue solely by this pen, or solely by this writing pad, or solely by this monitor, solely by these other assets, I will not be able to generate revenue, right? So what is cash generating unit? Cash generating unit is a smallest possible group of assets, smallest possible group of assets which can generate independent cash flows, which can generate independent cash flows. Let's suppose I have this pen. Can I generate cash flows with the help of this pen? No, I cannot. So I'll say, okay, I'll take this pen and I'll take this writing pad. Can I generate revenue? No. Where will the students see their screen? So I'll take this laptop also. So I have taken this pen, I have taken this writing pad, I have taken this laptop. Okay. Now, can I generate revenue? Yes, I can, but students will not be able to see me. Students will not be able to see me. For that I need a camera, right? So I've taken a camera also. I've taken the camera also. But now students will have to ask queries also. Where will I see the queries? So I need this monitor also, right? So I've taken all these 5 assets cumulatively. That forms a cash generating unit. That forms a cash generating unit. That forms a cash generating unit. Basically, smallest possible group of assets, smallest possible group of assets required to generate independent cash flows. If I say that I will use the laptop's camera, this writing pad and laptop, these 3 can generate me revenue, then yes, these 3 are my cash generating unit. So I will exclude the camera, I will exclude the monitor. Okay, so what are cash generating units? Cash generating units are the smallest set of assets. Okay, smallest set of assets or group of assets capable of generating independent cash flows. Generating independent cash flows. That are called cash generating unit. Those are called cash generating unit. Is that clear, guys? Is it clear to all? The meaning of cash generating unit. Now comes the question, how will you impair the asset? How will you impair the asset? So what you have to do for cash generating unit assets? First, write all the assets, write their carrying amount. Step 1, find the carrying amount of the cash generating unit. Find the carrying amount of the cash generating unit. I write the steps. Step 1 is carrying amount of cash generating unit. Step number 2 is recoverable amount of cash generating unit. Step 3 is calculate impairment loss. Now after calculating impairment loss, what you have to do is first allocate to goodwill, impair goodwill 100%. Okay, or to the extent of impairment loss, okay. Then second, if any asset is specifically impaired, if any asset is specifically impaired, okay, then third, finally, or third I'll write other assets, other non-current assets, whether they are tangible or they are intangible, doesn't matter. Whether they are tangible or intangible, doesn't matter. All other non-current assets, okay, in ratio of their carrying amount, in a ratio of their carrying amount. Okay, let me take up a question on this one so that it will become more clear to you guys. Okay, let's solve question number 43. So what does it say? The business comprises a cash generating unit which has the following assets: goodwill is there, patent is there, property is there 10 million, plant is there 15 million, net current assets is there 2 million, total is 35 million. Following an impairment review, it is estimated that the value of patent is $2 million and the recoverable amount of the business is 24 million. Okay, what is the carrying amount of the property after the impairment review? Let's solve this question. Naman, just I'm holding on your query for 5 minutes. Let me solve this question and then I'll come to your query. Okay, I think with this question your query will be resolved. Question number 43. Okay, now let me write all the assets, please. Goodwill, patent, property, goodwill, patent, property, plant and equipment, net current assets. So this is the carrying amount. 3, 5, 10, 15, 2. 3, 5, 10, 15, 2 is 35 is the carrying amount. Recoverable amount is what? 24. So what is the impairment loss? Impairment loss is 11. Now how will you allocate impairment loss? First you will impair the goodwill fully. Now patent, what is the see what is the recoverable amount of patent? Well, patent has a value of 2 million. So to bring it revised carrying amount, I'll write here revised carrying amount. Now so revised carrying amount. Okay, now for this it has to be 2 here, right? So how much to impair? 3, right? Now so it is nil here, it is 2 here. Now impairment loss it should be 11 total, right? Net current assets should not be impaired. So the rest impairment loss, that is 11 minus 6, that is 5, has to be allocated to this one, right? These two. So how will I allocate? 5 multiplied by 10 by 25. Now 5 multiplied by 15 by 25. So it is 5 divided by 5, 25, 5 and 2, right? So it is minus 2, that is 8. It is 3, it is 12, not 8, not like that, 12. So this will be 2. So what is the net carrying amount of the revised carrying amount of the CGU? 2 plus 8 10, 10 plus 2 12, 12 plus 12 24, 12 plus 12 is 24. I hope this question is clear to all of you. But now let me make one change. What if rather than 24 it would have been 34, not 34, 3 plus 1, just a minute, plus 1 4 31, it would have been 31, it would have been 13 1. Then what would have done? Then again there will be no impairment loss like this one, no impairment loss of this one, no impairment loss of this one, right? Let's remove it off. So what is total impairment loss? Now tell me. In that case, the total impairment loss would have been 4. Out of that, first I will impair this and the remaining I will charge onto this. It's not that I have to impair the goodwill always 100%. No. Either impair the goodwill fully or recognize the full impairment loss as a goodwill in the goodwill. Okay. So that's how. Basically, what I have to understand, what I am trying to explain here is goodwill will be impaired first. If this is not the case, the goodwill will be impaired first. Is it clear, guys? 3 from patent and 1 from goodwill. No, Vidisha, not 3 to goodwill. Not 3 to goodwill. Because it is question is clearly saying that the patent has a value of $2 million. So we have to definitely decrease the patent. Okay. So that's how it will be. Let me just okay. Now that's question 43. Now tell me, Naman, is your query resolved or you still have any query? Naman? If that line about patent was not given, then what we would have done, you know what? In that case, we would have allocated the remaining impairment loss to these three. We were required to allocate the impairment loss to these three in the ratio of their carrying amounts. Okay. I hope it is clear to all of you. Basically, first we'll allocate the impairment to goodwill, then to the specific any assets that are impaired, then to the remaining non-current assets in the ratio of their carrying amount. Okay. Now that's 43, and 45 is similar question. You can solve it on your own. Okay. Now coming back to the topic. Impairment loss for a revalued asset. Now guys, generally what we have understood so far, we must know that the impairment loss is recognized where is impairment loss recognized in financial statements? Naman, you can discuss separately for that. Okay, we will not be able to take all the questions in the class. Okay, so now impairment loss is recognized in P and L, right? Impairment loss is recognized in P and L. Now, but what will happen if the asset is under revaluation model? What happens when we have asset under revaluation model? If we increase the value, we create a revaluation reserve. Now, when we increase the value in the past, we created a revaluation reserve. Now, when we are decreasing the value, don't you think we should take it from revaluation reserve? Rather than transferring it to P&L, the impairment loss should be adjusted with the, but in case of revalued asset, that is asset at revaluation model, asset under revaluation model, impairment loss should be adjusted with, tell me what, revaluation reserve. I hope it is clear, guys. I hope it is clear. This point is clear to all of you. Is this clear, guys? Not P and L, Rinki, not P and L. Okay, now coming on to last concept, that is reversal of impairment loss. Before we start on to that, I will tell you that goodwill once impaired is impaired for life. It will never be reversed. Okay, goodwill once impaired can never be reversed. Can never be reversed. Can never be reversed. Can never be reversed. Okay, now explaining the reversal of impairment loss. What does the standard say? First, let me explain that. Standard says that whenever the indicators which cause the entity to book an impairment loss, to recognize an impairment loss, that indicator, when it reverses, you can reverse your impairment loss. You can reverse your impairment loss. Okay, but you can reverse your impairment loss. Reversal is subject to revised recoverable amount or carrying amount had the asset not impaired. Not impaired initially. What is the meaning of that? Let me explain that. Let's suppose there is an asset costing $100. There is an asset costing $100. The life is 5 years. So definitely the graph will revolve like this. The graph will go like this, right? So it will decrease like this, 100, 80, 60, 40, 20 and 0, right? Definitely the graph will move like this. Tell me yes or no, right? Now what happens at the end of first or second year, at the end of first year, when the value was 80, okay, the asset got impaired to 50. First year, right? The asset got impaired to let's suppose 50. Okay, the asset got impaired to 50. Now what will happen? It will move like this definitely. Let me take a red pen. From here, definitely it will move like this now. Right? Now it moved like this. Okay, but what happens at the end of third year? Let me take up blue pen now. At the end of third year, that is it is 50. At the end of at the end of first year, it becomes 50. At the end of second year, it becomes how much? Tell me. 450 divided by 4 is 12.5, is 37.5, minus 37.5 minus 12.5 is 25. Is 25. Okay, now at the end of first, second, third, first year, second year, and third year, right? At the end of third year, it becomes 25. It becomes value is 25, right? Value is 25. Now, and the carrying amount is 25, and the recoverable amount here is, what will be the recoverable amount? First year, third year. Recoverable amount is 45. Now, tell me, how will I reverse the impairment loss? What is the reversal of impairment loss? Meaning thereby, what is happening here is 25. 25 is here. Just a minute, guys. Let me just put the graph properly. 25 should be somewhere here, right? Third year. Okay, 25. Now, and what is the recoverable amount? 40 is the carrying amount, if okay, and 45. This is 45. Now, okay. So what the standard says that whenever you have to reverse your impairment loss, meaning thereby reversal means you can only reverse things. Whatever bad happened, you have to erase it off. You cannot bring some good fortunes along with you, right? So now the standard says if you are reversing your impairment loss, the max you can do is you can come back here. You cannot go beyond this one. If you want to go beyond this one, you can, but by following revaluation reserve. But you can go through P&L using this only. Till this much only. Meaning thereby, if you want to reverse the impairment loss, you cannot reverse beyond the carrying amount if there was no impairment initially. So that's what. So now, let's suppose had the asset not been impaired, the carrying amount was 40. The carrying amount would have been 40, right? At the end of third year, it would have been 80, 60, 40, right? But let's suppose the revised carrying amount, if the revised carrying amount is 45, this is 40, then you can reverse the impairment loss only till 40. Let's suppose your revised carrying amount is 38 only. Then you can revise it till 38 fully. But yes, you cannot go beyond 40. You can be till 40, but if you have to go beyond 40, you have to go through other routes, not through reversal of impairment loss. Is that clear, guys? Is that clear to all? Tell me, guys, is that clear to all? Reversal of impairment loss is clear to all? Is reversal of impairment loss clear to all? Okay, fair enough. Let us solve one question. On that. This question is taken from your BPP activity 4, BPP workbook, not the practice kit. Taken from workbook, taken from workbook activity 4, right? Reversal of impairment loss. A head office building with a carrying amount of $140 is estimated to have a recoverable amount of 90 due to the falling property prices in the area. An impairment loss of 50 is recognized. Okay, fine. Now, after 3 years, property prices in the area have risen again, and the recoverable amount of the building increases to $120. Okay, the carrying amount of the building, had the asset not impaired, would have been $110. Now, okay, so what we have to understand here is 3 years back. I'll write here activity 4. 3 years back, what happened? Carrying amount was 140, recoverable amount was 90, and an impairment loss of 50 was recognized. Now what is happening? Property prices in the area have risen again, that is the impairment indicator have reversed. The recoverable amount increases. Okay, it says the recoverable amount is $120 million, and the carrying amount had the asset not impaired. Carrying amount had the asset not impaired on this time. Okay, had the asset not impaired is $110 million, right? So calculate the reversal of impairment loss. So what will you do? You can make it from 90 to 110. That's all. So only reversal of $20 million is allowed. Okay, that's all. Up to $110 million. That's all. Is that clear, everyone? Guys, few things. Whenever a question comes up on revaluation reserve, anywhere a question comes up on revaluation reserve, and you have to adjust the revaluation reserve. Like let's suppose this one. See, impairment loss should be adjusted with the revaluation reserve, or there is a revaluation loss that you have to adjust with revaluation profit or revaluation reserve, right? There is a revaluation loss which you have to adjust with revaluation reserve. Whenever you have to adjust anything with the revaluation reserve, check few things. And what are those few things? Let me write it here. Note. This is not related to impairment, guys. General note. It is general note. Okay. Whenever we have to adjust any amounts to revaluation reserve, check first thing that whether revaluation reserve is transferred to retained earnings at disposal or every year. If it is every year, check the balance of revaluation reserve before making the adjustment, because many times I find students adjusting the balanced amounts to the revaluation reserve, and there is no sufficient balance itself. Before making the adjustment. Is that clear, everyone? Guys, is that clear, everyone? So with that, we have completed our non-current assets, intangible assets, impairment of assets. We'll now move on to leases. But before that, we'll take 5 minutes break. And then we'll move on to leases. Tell me, guys, is that clear so far? Everyone till here? Okay. Guys, let's take a break of 10 minutes. Let's resume at 7:10 and we'll start leases. Okay, and then we'll start leases. Okay, let's break for 10 minutes. Let's resume, guys. Let's resume. Let's start with our next topic, that is leases. That is a topic 4 of today's day 1 of the ACCA FR revision series for September 2022. Okay, now is everyone back from break? Is everyone back from break? Fair enough. Let's start. Leases. So guys, when we have to discuss the lease, let's understand first what is a lease. So as we have discussed in our classes also, that lease is of 5 components. Lease has 5 components. What? See, lease definitely will have a contract for that, right? Now, whenever you are entering, this is a lessee and a lessor are entering into a contract with each other. When lessee and lessor are entering into a contract with each other, contract for what? Contract for what? Contract to take any asset, the right to use of any asset, right? Contract to take the right of use. Contract to take the right of use. When I am taking the right of use, basically when I am as a lessee taking the right of use of what? Of an identified asset. Of an identified asset, right? Of an identified asset. Now, if I am taking the right of use of an identified asset, will I get it for the full life? No, I'll get it for a specified life, which is called as lease term. Right? Now, will I get it for free? No, I'll have to pay lease payments. I'll have to pay consideration for that, which is called as lease payments, right? So what are the 5 components of a lease? Lease is a contract for right of use of an identified asset for a specified period of time in exchange of a consideration. Is that clear, guys? Leases. Now, how to identify whether a contract constitutes a lease contract? Because not all the contracts are a lease contract, right? But how to identify whether this contract is a lease contract? So it should have 3 characteristics. What are the 3 characteristics? First characteristic, there should be an identified asset which should be either explicitly or implicitly specified in the contract. Either explicitly or implicitly specified in the contract. Okay, plus lessor should not have substantive substitution rights, meaning thereby the lessor should not have the rights to substitute the asset as and when he wants to, but the lessor can substitute the asset if the lessee requests. The lessor can substitute the asset if the lessee requests, but the lessor on its own cannot substitute the asset. Okay, lessee might request in the case, let's suppose when the asset is damaged, or when the asset requires repairs, or when the asset requires maintenance, right? In that case, lessee might hand over the asset to lessor. Okay, and till the time lessor is repairing or maintaining, doing the maintenance of the asset, or basically repairing the asset, for that meantime, the lessor might give a substitute asset to the lessee, right? That we are not covering. So it means lessee has that right. Now I am telling lessor should not have substantive substitution rights, SSR, substantive substitution rights. Okay, is that clear? This is the meaning of identified asset. Now tell me, when I am taking the right of use of any asset, am I getting the ownership? Tell me, am I getting the ownership also? No, I am not getting the ownership, right? I am not getting the ownership. I am getting only the right to use. So that's what. So I will get the right to direct that how the asset will be used. I will get the right to direct the use of the asset. Basically, I will get the right to determine how and for what purpose, how and for what purpose the asset will be used for. How and for what purpose the asset will be used for. How and for what purpose the asset will be used for, right? Now tell me, if I have the right to determine how will the asset be used, don't you think all the economic benefit that is coming from the use is also mine? All the economic benefit that is coming from the use is also mine, right? I'm not talking about the ownership, I'm talking only about the use. Benefits from use, not from the ownership. Benefits from the use is also substantially should be mine, the lessee. Okay, so these both should be with lessee. Okay, not these both, I can say, rather I can say these three, all the three should be with lessee. All the three should be with lessee. Should be with lessee. Is that clear, guys? Is that clear to all? Is that clear to all? Is that clear to all? Okay. Now coming the initial measurement, how the lease liability and the right of use asset will be measured initially. So initially lease liability will be measured at present value of future lease payments. Now the question comes up, what comprises the future lease payments? It can comprise fixed lease payments. It can comprise in substance fixed lease payments. Now what is the meaning of in substance fixed lease payments? Meaning thereby a portion of it is fixed, a portion of it is variable. Let me give you an example. If the contract says that the lease payments are $20,000 per month, or 20% of the cash flow generated from the use of the asset, whichever is higher. Now let's suppose if the 20% of the cash generated from the use of the asset amounts to $12,000, how much will you pay? 12,000 or 20,000? 20,000, right? If the amount of 20% of cash flow generated from the use of the asset is 18,000, how much will you pay? $20,000. If the amount of 20% of cash flow from generated from the use of the asset is $24,000, how much will you pay? 24,000. So in this all the three amounts, what remains constant? 20,000, right? That is in substance fixed. That is in substance fixed. All others are variable. All others are variable. All others are variable. Okay. Now plus variable linked to index or rate, linked to a rate, right? Because what happens, let's suppose if I'm entering into a lease for 5 years, it's not that the lease payments for all the 5 years will remain the same. It might say that the lease payment of lease payment is $20,000 for the first year. From the next year, it will increase 10% every year. Though it is variable because it is linked to a rate, but still it is fixed. We can calculate that. Still it is fixed, right? Now plus purchase price. In what case will we include purchase price? In what case will we include purchase price? If the lessee is reasonably certain that yes, it will purchase the asset at the end of the lease term, plus the option should be given by the lessor to the lessee. If the lessor gives the option to the lessee and the lessee also thinks yes, I can purchase, in that case you have to include the purchase price also, which will be paid at the end of the lease term, right? As a future lease payments, plus guaranteed residual value, plus guaranteed residual value. Is it clear, guys? Now what is the right of use asset? Right of use asset means, now whenever you purchase any asset, you recognize it at cost. Right now we studied this cost might have amount already paid, amount already paid, plus it might be the case that some amount is not paid, amount not paid, amount to be paid in future. Right, so in that case what will we do? Amount already paid might be upfront lease payments, it might be initial direct costs like brokerage, right? It might be lease incentives, plus amount to be paid in the future is called as lease liability. So that's how a right of use asset is recognized initially. Is it clear, guys? Is it clear to all? Now what is journal entry? The journal entry becomes right of use asset account debit to bank. In that you can write here upfront lease payments, to you can write here lease liability, to again bank. This might be initial direct costs. Again you can write here that's all. Lease liability, it will be at present value of future lease payments, right? So that's how a journal entry is to be recognized for the initial measurement of lease liability and right of use asset. Is that clear, guys? Everyone, is that clear to everyone? Is that clear, everyone? The initial measurement of lease liability. Very good. Now coming on to subsequent measurement, how's the liability and the ROU asset will be measured subsequently. Okay, lease liability will be measured as per amortized cost method, right? As per financial liability. If you can recall financial liability, how do we measure financial liability? Right? Similarly we will recognize for lease liability also, right? How? That is opening lease liability plus finance costs minus lease payments is equals to closing lease liability. Are you able to recall this, guys? Tell me, are you able to recall this? How to measure the lease liability subsequently? Basically the opening lease liability plus we'll add the finance cost at the rate of interest, right? At the rate of interest, incremental borrowing rate of lessee basically, or the implicit borrowing or the implicit rate of return, right? Implicit rate of return of the lessor. We'll take either whichever is given, we'll take that and find the finance cost minus lease payments which is made is equals to closing lease liability, right? Is that clear, guys? Now how will the ROU asset be measured subsequently? Amortize over the lease period. Amortize the ROU asset over the lease period. Basically understand it, guys, that any asset has to be depreciated or amortized over the useful life of the asset. In this case, what is the useful life for a lessee? The period of lease, right? So that's why we are amortizing over the lease period. But I'll write here one exception. If purchase option exists, plus lessee is reasonably certain to exercise the purchase option, then in that case the right of use asset has to be amortized. Right of use asset is amortized over remaining useful life. Has to be amortized over remaining useful life. Is that clear, guys? Is that clear to all? Now, many times I have seen the question asks for to calculate current portion of lease liability or non-current portion of lease liability. How to do that? How to calculate the current and non-current portion of lease liability? Guys, understand that there can be two instances in the question. There can be two instances. That is, what are the two instances? Instance number one is payments made at end of year. Second instance is payment made at beginning of year. Okay. Now, if the payments are to be made at the end of the year, then in that case your non-current portion will be balance at the end of next year. Okay, and what is your current portion? Your current portion is your total lease liability minus non-current portion. Right? Now, if the payments are to be made at the beginning of the year, I have already explained the logic in the class, right? Now cannot explain because the explaining the logic itself will take half an hour or 1 hour, right? So we cannot explain the logic now. Now, if it is payments made at the beginning of the year, then the current portion will be payment to be made in next year. Okay, and non-current portion will be total lease liability minus current portion. Is that clear, guys? Is it clear to all? Guys, is that clear to all? Now, practical exemption. Okay, guys, we must understand that lessee is given practical exemption. What? If the lease is of short-term nature, if the lease is a short-term lease, that is up to 12 months, the lease term is up to 12 months, or the lease is of a low value item like a mobile phone or like a laptop, low value item. If the lease is of a low value item or if the lease is of a short term lease, standard says that there is no requirement to recognize. Okay, do not recognize. I'll write here what we have to do and what we don't need to do. Okay, standard says No recognition of lease liability and ROU asset. No. Rather, what you have to do is uh, recognize lease payments as rent expense, lease payment as rent expense on straight line basis over the lease period, on straight line basis over lease period. What is the meaning of straight line basis, guys? Let me take up an example for that. Okay, let's suppose I have taken a mobile phone on rent on 1st January X1 for 6 months. For 6 months. For 6 months. Okay, my year ending is 31st of March X1. Okay, the lease rent is 10, 15, 20, 25, 30, 35. Now, what is the amount of rent expense that I should recognize in this month, in this period? What is the rent expense? Tell me. What is the rent expense? So ideally students will say 10 plus 15 plus 20, right? That is 30 plus 45. But I will say it is 10 plus 15 plus 20 plus 25 plus 30 plus 35. No, 10 plus 15 plus 20 plus 25 plus 30 plus 35 divided by 6 is 22.5. 22.5 multiplied by 3 months is equals to 67.5 is the rent expense. That is called straight line. That is called straight line. That is called straight line. And what did I do? How did I calculate 22.5? It is I aggregated all divided by 6. That is average. That is I did the average and then I did multiplied for 3 months for this one. Straight line. I will recognize rent expense on a straight line basis, not 10, 15, 20, 25, 30. No, I did not do like that. I recognize on a straight line basis. Is that clear, guys? Is that clear to all? The practical exemption is clear to all? Okay, fair enough. Now, moving on to a new concept of sale and lease back. A new and the last concept for the day, that is sale and lease back. Okay. Guys, in this we have studied in the class the model of the fully sale and lease back, right? The full model of sale and lease back. And we studied it that what happens is Indigo, this model was initially started by Indigo, right? So in this two transaction happens. In this two transaction happens. One is sale and another is lease back. Another is lease back. For sale, what is the entry? Bank account debit to asset to gain or loss on sale. When I take on lease, what is the entry? Right of use asset account debit to lease liability. Now, what is the entry for sale and lease back? Just we have to merge these two entries. Just we have to merge these two entries. How? So entry will be bank account debit, right of use account debit, then to asset to lease liability, Then to gain on sale and lease back. So bank is sale proceeds. Bank is sale proceeds, right? ROU we will discuss. Asset is derecognized at its carrying amount. Lease liability is present value of future lease payments, right? Gain on lease sale and lease back is the balancing figure, right? Now what is the ROU asset? So as I was discussing in the class also, that right of use asset is not recognized at its at this value, present value of future lease payments, as we used to do it normally. Why? Because the reason is, see what happens, we already owned the asset priorly, right? When we owned the asset, we had 100% control over the asset. When we sold the asset, we lost 100% control over the asset. But when we took the asset back on lease, we reacquired certain percentage control over the asset, right? So we have to recognize the ROU asset at that percentage control over the asset, right? So ROU asset will be recognized at let me take a red pen. It is recognized at carrying amount multiplied by rights reacquired. Okay, and how to determine rights reacquired? It will be, what is the amount that you have paid under this contract, valued, divided by what is the price that you should ideally pay to acquire 100% control. What is the price you should pay to acquire 100% control? What is the price you should pay to acquire 100% control? That is fair value, right? That is fair value. That is fair value. That is fair value, right? So carrying amount multiplied by lease liability divided by fair value is the value at which right of use asset is to be recognized. Is that clear, guys? This gain or loss on sale represents 100% loss or gain or loss on 100% sale, right? Now here we will reverse, here also we will recognize some loss on lease back, right? Why loss on lease back? We are reversing the gain. We are reversing the gain to the extent of rights that we are reacquiring, because we can recognize gain or loss only to the extent of the rights transferred, not on the rights retained, right? So we have to reverse the gain. That is, we have to book a loss on lease back. If it is a gain, we have to recognize a loss, right? Loss means reversal of gain to the extent of rights reacquired, so that on a net basis, it is only the gain or loss on the rights retained, gain or loss on the rights transferred, that is recognized. That's all. Nothing else should be recognized. Is that clear, guys? Is that clear, guys? Now one more concept. All of you guys, please pay attention. If this contract, it says that if this does not qualify to be a sale contract, okay, then this will not qualify to be a lease contract also, right? But yes, SBI has paid the sale proceeds to Indigo, and Indigo is paying the lease payments to SBI, right? SBI has paid sale proceeds and Indigo is paying lease payments. But if there is not a sale transaction, it will not be a lease transaction. So then what does it become? This will not be a sale proceeds, rather it will be a loan, and this will not be a lease payment, that is repayment of loan. Meaning thereby, if a sale and leaseback transaction does not qualify to be a sale transaction, the whole arrangement will become just a financing arrangement, just a loan arrangement. Is that clear, guys? Is that clear to all? Okay, fair enough. Now guys, a few things we have to take care in the exam. which I have noticed multiple times in the test which I conduct for students, that questions ask total charge. Calculate the total charge relating to right of use asset. If the question asks total charge relating to right of use asset, only calculate the depreciation or amortization. If the question says total charge relating to lease liability, only calculate finance cost. If the question asks total charge and it's silent whether right of use asset or lease liability, then calculate for both. Question might ask calculate lease liability. Question might ask you to calculate current portion of lease liability. Question might ask to calculate non-current portion of lease liability. Be very mindful of what the question is asking for. Be very mindful of what the question is asking for. Read the question properly. If you don't read the question properly, the answer which you will are giving is a waste, is just a waste of time that you will be doing in the exam. So read the question properly and then answer it. Is that clear, everyone? Is that clear, everyone? Okay, fair enough. So that's all for the day, guys. I'll be sharing the schedule for tomorrow as well. And please revise these topics. Please solve questions of these topics. If you solve these questions of the topics before the next class, I can guarantee, guys, no one can stop you from securing good marks, at least in these topics. Because these topics are fresh now with your mind, right? Please solve it upfrontly. It will take you 3-4 hours. Spend it right now and solve it off. It will be the best revision that you can ever have. I think if you can solve the questions right now. Okay, what I'll do is I'll be sending these notes, the questions which I have selected, the important ones. Okay, all these things in the group. You can solve those questions, and you can solve the questions of the book of which you are referring, whether Kaplan or BPP or any other book if you are referring to. Okay, that's all for the day. Thank you, guys. Bye bye.